Let's now get into the risk and return characteristics of equity securities. So let's say I do invest in Alibaba, right, in yuan directly in China, in the Shanghai Stock Exchange from New York. And the yuan becomes strong, right? It strengthens. So if the yuan strengthens, I get two benefits. And let's say the Alibaba stock also goes up and they pay me some dividend as well, right? So I get a dividend income, I get a capital gain because the stock price goes up in yuan and the yuan strengthens, so I get a foreign exchange return as well. So that's the return, but obviously there's risk involved. What if Alibaba as a company, as a business, is not able to earn the future cash flows that I thought it would earn when I was buying the stock? If that doesn't happen, the price is not going to go up, it's going to go down, right? They're not going to be able to pay me a dividend. And if the Chinese economy also doesn't strengthen, so there's a probability that instead of strengthening, their currency might weaken. So this is what we have to understand. And of course, common shares are riskier than preference shares because preference shares get a precedence in terms of cash flow and liquidation both, right? You can even have cumulative preference shares, so even if the dividend is missed, it's accumulated and next year you can get both. You can have puttable shares, and that's obviously for the case of preference shares, and like I was telling you earlier as well, that you can put them back to the company and redeem. So they can be redeemable, where you can get your original investment back, right? The company can have callable as well, where if they feel they don't want to pay you that fixed dividend anymore, so they can call the shares back. Now, what is the use of equity, right, from the company's perspective? Let's say you start a company and the original owner puts in $10 million and they take a loan from the bank for 10 million. They want to expand, the bank might give them another 10 million, right? They want to expand, the bank might give them another 10 million. But at a certain point, the bank is going to say, hey, these 30 million that we have given you, and including the 10 million that you have helped you get these assets worth 40. If there is a fall in these assets, let's say they go to 20, of course you lose your 10, but then I'm going to have to lose, the bank will say, I'm going to have to lose some money, and I don't want to do that. So the bank is going to be looking at the debt to equity ratio, and they want your equity to be enough to absorb any losses, right? So if the company wants to expand, they have to not just raise debt capital, they have to raise equity capital and have enough cash to keep paying the interest on the debt as well. So liquidity has to be managed. And it's a very, very interesting way to do that, not just through selling equity, but even as a way to motivate your management that, oh, if you do well, we're going to give you the stock. And let's say the stock price is $10 right now. We'll let you buy it for 10, but you work really hard and take the stock price in the market to 20, right? So then you will be able to buy it from the company at 10 and sell it in the market at 20. So this could be used through employee stock options to incentivize your management. So that is, of course, a very, very powerful tool in this entire system that we have, the modern financial system. So now, obviously, the management wants to increase the value of the equity, not just the book value, but also the market value. Now, what does that mean? See, if I am a company and there is a value of those assets, and let's say that's 40, and I've taken a loan of 30, and the remaining is my equity. If the book value of the assets go up, let's say it goes to 50, my equity book value goes to 20. Now, even before the book value of the assets go up and the cash flows are there, and we realize the profits and increase the value of our assets and our equity on our books, the market value of equity usually starts going up even before that, in expectation of the higher future cash flows and the profits, right? So this is basically what happens, is that, of course, what you're doing in terms of the management, having higher profits and then your retained earnings going up, so your book value going up, that is what directly happens from the actions of management. But the market is seeing the behavior and can predict this from before, and the market value will start going up in addition, in advance of any of that revenue and profits being generated and then retained in the business. And it could work the other way around as well. So if you're doing a poor job, before your book value even takes a hit, your market value will take a hit before that, right? Are the book value and market value the same? Hardly, right? But I would say that maybe in banks they will be relatively close to each other, because the book value on banks is as close to the fair value of assets as much as possible, because as you know from your accounting studies that there are different types of assets, especially non-current assets like property, plant and equipment, which are measured at historical cost. So since a lot of the assets on the books are measured not on fair value but on historical costs, and also internally generated intangibles are in a big way missing from your books, so that therefore book value and market value are going to be different. Very frequently they will be very different. Very seldom will be the case that they're actually close to each other. Now guys, so what's the point of investing in equity? I mean, what do you really want to see? What you want to see is what is the income that this company is generating for you, and how much money have you put in to this company. Now this is a mixed ratio, because income is coming from income statement and equity is coming from balance sheet. And income is for a period, let's say from Jan to December for a particular year, right? Whereas balance sheet is going to be as of a certain date. So if you want from Jan to December as well, you'll have to take the average equity, which means beginning balance and ending balance will be added and divided by 2, right? And one might think, okay, what is the beginning balance? Well, it is the ending balance of the previous year. So you take average book value per equity, or you could take beginning, and then that could be used as just a simpler way of doing it. It's not theoretically the most correct way, but that is also used by some people when calculating ROE, that instead of taking the average, they just take the beginning. And you know, there is a logic behind this as well, because I mean, this income has been generated based on the equity that was provided to the company at the beginning of the period, right? So that is logical as well, but the theoretically more correct way is to take the average, because throughout the year equity values can change, right? Shares can be bought back, new shares can be issued. So since this is for a period, we should also take the equity average balance throughout the period. But both methods are used, and there is a logic behind both. Now guys, this is something which will be developed across your next few learning modules, especially in the last learning module of equity, where you understand what is the way where you can calculate what is the return that equity holders want, what is the return that they want, and what about the cost that you have to pay. Is it going to be the same or not? And what you have to understand is that there is a moving part in all of this. So let's say you originally issued 10 million worth of equity, right? And you're paying 10% on it, right? Which means, let's say you're paying 1 million per year to this 10 million. And that is acceptable to your equity investors as well, right? So let's say you issued a million shares of $10 each. But then that share price goes up in the market. So if that share price now goes from 10 to 12, now if I'm buying your share at 12 now and I'm only getting $1, so if it's $10 million total with 1 million shares into $10, right? So it's a million shares into $10 per share, which means you're paying a million out, which is basically $1 per share that you're paying out. But the share price goes up, and if I'm getting only $1 on this share, so that's not 10% anymore for me. And I want 10%. My required return is still 10% based on the risk that is there in your business. And again, how and what that means is something which you will learn when you get into the capital asset pricing model. That, okay, how do we incorporate the risk of the business, and how does this help us then calculate what is the required return on equity? But the point I'm trying to get across here is that if the stock price changes, this return on equity which is required might not be the same as the cost the company is willing to pay, right? So that could happen. And if that does happen, right, if the share price goes up or share price goes down, then it's going to be a problem. So we're going to talk about this later in another learning module where you learn about the ways to come up with what the cost of equity is going to be from the company's perspective based on what the investors are requiring. And of course, eventually the company has to pay that, otherwise people will start selling their shares. So we'll develop a higher level understanding of these in a subsequent learning module. Right, so let's have a look at the summary here. We talked about the different types of equities, common shares, preference shares. We talked about the voting rights that you get with common, and you can have cumulative voting rights. You can have different classes of shares, right? We talked about preference shares that get a precedence over common. They can have cumulative dividends. They can be participating as well, and they can be convertible as well. We talked about the different classes. I gave you the example of Meta / Facebook. Then we talked about private equity and what are the different types of private equity investments, such as venture capital in startup, leveraged buyouts, management buyout where the existing management buys the existing shareholders out, and a private investment in a public equity company. We talked about American depository receipts, global depository receipts, where you can bypass those capital restrictions and invest in foreign entities without actually having to directly invest in those countries, or you could go for a direct investment as well. So we looked at global depository receipts, American depository receipts, global shares, which is not a depository receipt, it is the share of a company trading at multiple stock exchanges in multiple different currencies. And of course, you could have a basket of the depository receipts as well. We talked about all the different types of characteristics of common shares and preferred shares, with the emphasis being that preferred shares are less risky because they have a fixed dividend. Those dividends can be accumulated as well, and they will be paid out before your common shares get anything, right? So, of course, that's good. Even in the case of liquidation, the preferred shareholders get priority, they get precedence. However, common shareholders get voting rights, right? So that, of course, is interesting, but their risk is higher in all aspects when compared to preference shares. And we talked about what is the point of all of this, why is equity important, because companies cannot expand beyond a certain point using debt, so they have to increase their equity investments, right? And they can do that by selling shares in the primary markets, but then obviously they have to offer something to the shareholders, and that is what the shareholders expect in terms of your required return on equity. But that is calculated on the market value of the stock, which can be very different from the book value of the stock. And if that market value changes, right, if the stock price changes, then your cost of equity might not equal your expected return on capital. And then we need to see what is the situation over there. Does the market price go down, or does the company step up and pay a higher rate? So that's what's really important, that what is the return from the investor's perspective in terms of the income based on the book value, but also the income based on the market value, because they're not buying and selling it at the book value, they're buying and selling it at the market value.